get this question with my buyers. So when you're two people buying a home, one person has good credit, one person has bad credit, but the person with good credit makes no money and the person with bad credit makes all the money, what do we do? You're not going to like my answer, but the reality is that we have to use both credit scores in this scenario. So if you are the money maker, we have to use your credit score because you are actually the one that's going to be obligated, and on paper that's you are the one proving, right, that you can pay the loan. So part of that proof isn't just your income, it's your credit score. And credit score, like basically your credit score, the way I explain this is it's kind of like your financial report card, right? So one aspect of, making money is that you can show that you can consistently make money. But the other piece is that a bank wants to know that if they lend you money, you are going to be likely to pay it back on time. That is where your credit score comes into play. That's also why, unfortunately, when there's two people, and this happens all the time, one person, they have great credit, but they don't make any money. The bank, like that person they can't be approved for a loan on their own because they don't make any money. And when it comes to getting approved for a loan, there's kind of three core things that banks look at. It's going to be number one, the income that you have, right? Like your income is going to be a huge indicator of can you get approved or not for a loan. Number two is going to be your credit score. And that's basically your trustworthiness score on if a bank gives you money, are you likely to pay it back on time? The third thing that can implicate this on occasion are your reserves. So the amount of money that either you have to put down for the down payment. Sometimes that can alleviate the other two or help offset the other two. But sometimes too, it's how much money do you have in savings? Because let me just paint a picture. So say you have low to middle credit, but you're putting a large amount of money down. Imagine that compared to if you have low credit and you're putting minimum down. Right? So in a bank size, if you have a low credit score, that already means that there's potentially some risk of you not paying them back. But then if you add on top of that you're putting the minimum down, that means you have like the least amount of skin in the game. They're going to be a little more worried that there's going to be a problem later on down the line. What that actually means for a lot of people is it's not always about getting approved or not approved. This is where your interest rate comes into play. So an interest rate is basically what a bank is going to offer. It's like the cost of you borrowing money from a bank, right? That's what an interest rate really is the bank's way to make money on you borrowing money and then fronting that money to you. So when you are a riskier client, they have a premium to borrow money. So when you have a lower credit score and when you're putting the minimum amount down, those are deemed as risky factors, okay? And with those, that often means that your interest rate is higher because you're like on paper, it looks a little bit more risky. Whereas, let's say you have like an amazing credit score, like 780 and higher, but you're putting minimum down. Well, they're not going to be as bothered because you have on paper, your report card for borrowing money and paying it back on time is very high. So they're not as worried about it. So this is where, I always say this, like interest rate is super personal. I use a couple websites to just see like what the average or like the market rate is. But a lot of the time, those are based on doing 20% down. They're a lot of the time like on limited loan amounts, all this kind of stuff. But interest rate is always really personal. And the reality is that interest rate is actually based on your safety and what a bank deems as your risk factor with you paying them back in a timely manner. So the more risky you are, the higher your interest rate will be. The less risky you are, the better your interest rate will be. So like honestly, 10 out of 10 times, if you have a 780 and put zero or like put minimum down. So if you're a first time home buyer, if you do 3% down, you're going to have a very different interest rate than somebody who has a 640 credit score. And you're also putting the minimum down. I feel like interest rates in general are so misunderstood. They're very like demonized in the world of home buying because for a few years we all got very spoiled and had super low kind of like historical numbers. But the reality is that, rates today are actually fairly normalized. The thing that's really changed are home prices. I say this constantly. Homes today are much more expensive than they were 5 or 6 years ago. That's just the reality of it. But when it comes to your rate, please just keep in mind, this is a personal number that you will receive based on your risk factors that a bank is looking at. And again, that's going to be based on your credit score. That's going to be based on the amount of money that you make. That's going to be based on the down payment that you put down. That's going to be based on the assets that you have. Like there's just multiple factors that go into this. And again, a bank will then look at all of those factors and say, okay, what we feel is that the risk to take this client on is this. And so that number is obviously going to go up or down depending on how many risk factors you have, when you're applying for a loan and saying, hey, can I borrow a lot of money to buy this house? A lot of the time the answer is yes, but the rate at which you can borrow that money is so dependent on your personal situation. As just a side note, I always say this, if you're looking to buy within the next 6 months or less, definitely, best thing to do really at this point is to run your numbers. I think that a lot of people wait to talk to anyone on the financial side, on the mortgage side, until, in my opinion, it's like a little too late, or like they've already looked at a house and they love it and now we're trying to like crunch everything together and make it work. Not really my recommendation. Makes things stressful, makes things overwhelming. Your better case scenario is to run numbers, figure out where you are, figure out like what your rate's going to be, figure out what your purchase price can be realistically, and then from there determine, okay, these are going to be the next steps that make the most sense for me, because then you're making it from a place of knowledge, not from a place of chaos and overwhelm and like we're on a backwards timeline because you have a house and like you want to make it happen. Comments are always open if you have any questions. Link on my profile. First two options. First option is going to be if you think you want to buy within the next 6 months or less. Second option is if you think you're wanting to buy within the next 2 years, but your timeline is a little further out. That option is going to be for you. As always, I love you guys so much. Hopefully this is helpful and gives you some insight into credit score, risk factors, all that good stuff, and how that plays into your interest rate.